asset managers, when they need to move the money, and a lot of them are ready to do it. They've been in the market because they got to be, but they don't trust it. And as soon as you give them a sharp stick in the side, they're going to start moving that money. And they're going to look at what's working, what's been holding it, what's been going up this year. Well, gold and silver, despite the pullback. And then they look at commodities and they say, well, they're still very cheap. They're not going down. Last year and a half, there's no down in the Bloomberg. Now, the Fed's taken credit for dropping commodity prices, but actually commodities already dropped before they started their rate cuts. Okay, so it's in its own world.
In many of his interviews, momentum structural analyst Michael Oliver emphasizes the importance of gold and silver as safe haven assets, particularly during economic uncertainty and stock market volatility. These precious metals have historically performed well when equities struggle, as investors flock to them for their stability and tangible value. A prime example of this trend was evident during the 2008 financial crisis when the stock market was in freefall, yet gold continued to rise in value. Between the early 2000s and 2011, the price of gold skyrocketed from around $260 to over $1,900 per ounce, fueled by fears of a global economic meltdown and mounting inflationary concerns. Though more volatile, silver mirrored gold's upward trend, benefiting from the same market dynamics. Even during the post-crisis recovery, when the broader economy was improving, gold and silver remained attractive, offering a hedge against inflation and currency devaluation. In recent years, both gold and silver have demonstrated resilience, even amidst the prolonged bull market in equities. Starting in 2015, despite the ongoing rally in major stock indexes such as the S&P 500, both metals experienced significant growth. By late 2024, gold has either matched or outperformed the stock market, which is noteworthy considering the overall bullish sentiment surrounding equities. Silver, known for its greater volatility, has also seen impressive gains, further solidifying its position as a strong alternative investment during market uncertainty. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
The fact is that when the stock market has a major bear, everything does not go down. I know a lot of people think, if you're going into a recession or depression or whatever, everything has to go down. That's not true.
You're quite different, let me add, than a lot of people on that. You have a different opinion.
A lot of people think that, if the stock market goes down, big gold's going to go down. Well, it's simply not true. There are few instances during a gold bull trend, such as the bull trend from 2000 to 2011, where gold went from like $260 to $1,920. During the middle of that, there was a sharp break in October of 2008, coincident with a sharp drop in the stock market, which was already a year off its high at that point. But then gold turned around and continued on up, despite the fact that the stock market took years to regain its highs. Okay. So, but in history, if you go back like early 1900s forward and look at all these big cycles in the stock market, you'll see that during that time, gold went up. No, it wasn't month by month, week by week, inverse relationship, but it was a broad investment grade opposite trend. Now, back in the 20s and 30s, you couldn't trade gold. The U.S. government came in with the wise from above and no, you can't have gold. Okay. But homestake mining was tradable, major gold mining. Homestake mining went up 1,000% as the stock market went from its 29 high to its 32 low, which was like a wipeout, 80%. Okay. And yet homestake mining went up 1,000%. Okay. Then when you go into the last 50 years since gold's been legalized in 75 and look at the bear trends in the stock market, for example, the stock market went into a wasteland where, from an investment point of view, you didn't make any money from the mid 70s through the early 80s. Gold do then? Well, it went from $30 to $850 by 1980. Okay. Yeah. And by the way, the Fed was raising rates all during that latter phase in 1980. Did that stop gold? No. Okay. So Fed rate rises don't matter. It's the overall monetary degradation, which is ongoing, despite their flip-flops on rates. Okay. And then you look at the period, 2000 to 2002, where the stock market got cut in half, NASDAQ got cut by 82%. And in 2000, if you bought gold by 2002, it was well off the low, and it continued on up till 2011. Well, the stock market, as I said, like NASDAQ 100, never even made a new high above its 2000 high until 2015-16. So all during that time, gold had risen. Well, the stock market was a wasteland. Okay. Then now in recent months, however, starting from 2015, gold did start up, and the stock market was still in the middle of its bull. It was already 5-6 years off its low, but had more to go. And yet gold still went up and has matched, which people don't realize, the percent gain year to date. Gold is up as much as the stock market. And who knows, in 2 days, it might be up more because the stock market going down and gold firming through here. Okay. People don't realize that. Why is that asset category firm? It's not exploding. Gold's not exploding. It's going up nice double-digit percentages. It's actually, as of the November close, especially, you were actually up more in gold and silver than you were in the S&P and the NASDAQ. And who knows, by year end, it may even be further. Nobody's noticing that. They're all fumed and fired up about, especially the tech end of the market, the leadership end. And it has all the attributes of a bubble. In fact, there's a lot of fundamentalists out there who recognize this, smell the bubble, can measure the bubble by all kinds of valuation metrics, which we don't use, and are highly suspicious. And yet, when they say that, people laugh at them. And I understand that, I've heard from some, I can't tell you whom, but from a major brokerage firm, a manager of a major office of a major well-known brokerage firm, who told me that the thiever among his investors he's never seen like this before. And he said, and the leverage that they're using in the stock market is like triple, way more than he's ever seen customers use leverage in their stock positions.
Wow, that's scary.
Yeah, well, maybe it goes on forever, right? Or it doesn't. But the problem is, even if that's true, the question is when. When does it actually break? That's a technical issue. But what we're arguing at MSA is we see the technicals now such that if you sneeze a little bit at the end of this quarter, as you're starting to do, and wobble, not dangerously price-wise off the high, but just enough to get you in position in relation to the new quarterly structures, momentum structure. Once you blow those, the bridge over the River Kwai comes down. And it could do it. It's likely to do it suddenly because when you ambush a bubble market, it doesn't do it slowly. They pull the rug out from under you so quickly that you 20% loss very rapidly. Now, put that in context. Most people, investors, average folks, are hurting because of other factors, like the continued high prices at the grocery store and so forth, the mortgage rates and all that. But the one place they're having a good time is the stock market. So no wonder they're going crazy there because it's working, right? Okay. So instead of being enthusiastic in 5 or 6 different aspects of there's one area they're all focused on, and they've gone nuts. When you take that asset category and you take your retirement account and take 20% off of it fairly quickly, you don't have to drop a crash 30%, just say 15, 20% quickly. Pain is going to occur. And there's no place else where there's pleasure. Okay. So and what assets doing well? That's when asset managers move the money flow over to the categories that seem to be doing well or have less risk, greater reward.
Recent market developments suggest we may be on the cusp of a significant shift, with many indicators pointing to potential vulnerability in the stock market. According to Michael Oliver, the momentum structure of the S&P 500 and NASDAQ is weakening, raising concerns that a major correction could be imminent. As we approach the close of the current quarter, these markets are wobbling, and the new quarter may bring a dramatic shift in momentum. While it's unlikely we'll see a crash as severe as those of 1929 or 1987, Oliver suggests we could experience a sharp, layered decline over a more extended period. This shift will likely affect investor confidence, especially for those accustomed to the idea that stock prices will always rebound. Historically, the Federal Reserve has responded to market downturns by injecting liquidity and lowering interest rates to stabilize the economy and support asset prices. However, this approach has often been limited to stock market interventions, leaving commodities, including precious metals, to perform differently during times of crisis. Oliver's analysis highlights the importance of diversifying portfolios to include assets that fare better in economic downturns, such as gold and silver.
The market has been drugged for a very long period of time, and errors have been made on a micro and a macro level, not just in the market, but in, everyday realities. And when the bubble breaks, it will unleash the errors. Now, that's an issue of timing, because obviously it's even gone past the point of, what you might say is of fair balance. Okay. It's just like the dot-com. It was in the last 5 years of that bull market that you gushed on the upside because of the dot-com phenomenon. And it was all true. Fundamentally speaking, the internet bubble was quite valid. It did change our lives for decades to come and forever. It really changed our lives more than even people thought back then. And yet we had a bubble, and it collapsed 82% in 2 years, NASDAQ 100, So, and it took it, by the way, till 2016, a decade and a half to actually get back to that nominal high price that the NASDAQ saw in the year 2000. So if you're a long-term investor and you basically have the view that, stock market always goes up, so basically just keep your money in the stock market, right? Okay. Well, you lost 15 years of your life there, just coming back to where you were in 2000. Now, when you factor out the degradation in the money unit, you factor in the degradation in the money unit over that 15 years, we've not done it, but you could do it. Basically money supply doubles every decade. So for 15 years, it's a huge collapse in the real spending value of the dollar. So when you measure something by the dollar and it goes back to where it was, it really isn't back there. It probably took till, anyway, you get the point. When bubbles break in the U.S. stock market, 29, mid-70s, dot-com, 2007 mortgage-based crisis, when you break, the Fed always comes in with all the ammunition they can muster, back to full throttle monetary liquidity, rate cuts, anything they can possibly do, balance sheet increases, and buying ETFs outright like they did during the COVID event. Anything they can do to artificially price up those assets that they deem virtuous and deserving of being priced higher than reality might otherwise have them. That's not commodities. They don't like commodity. Hell with the corn farmer. He can suffer. But we want those stock investors not to be hurting. Okay. Well, when we assess things technically, we see the same sort of, forget the price chart. Price chart looks lovely. Yeah, you had a break here today. You wiped out a couple of months in one day. Okay. But there are some structures below when we run quarterly momentum. Now, what do I mean by that? You measure each month's high-low close price, and you plot it on our chart. You got a price chart, right? Okay, everybody looks at it, weekly, daily, monthly, whatever. We measure that price action in relation to the 3-quarter moving average. It means for the last 9 months. And every new quarter, we adjust that average up because the quarter ends, a new quarter starts. We got a new 3-quarter average. So when you create the oscillator, what you're doing is you're plotting price in its relationship to this rising, in our case, a rising mean, the quarterly mean. It's almost the same duration as the 200-day average, by the way. And it's not the issue of necessarily of going back and breaking that average itself. Sometimes trend structures, when you plot the charts, aren't really, the breakage point isn't at the zero line where you break the average itself. It might be 10% above it or something. But anyway, the point being, we have structures below us now in the S&P and the NASDAQ 100 and sectors within the market that if you wobble at the end of this quarter, as we're starting to do, and we sort of expected that, wobble several percent off the high that we just saw, we're already several percent off the high, and close out the quarter such that, well, price is, a big deal, a little dip in the price, that doesn't break anything on the price chart, but you'll be in position on the stock market. As soon as you open the new quarter, when that moving average clicks up and the oscillator changes its metric, instead of the 3-quarter average where it is this quarter, it rises, okay? You'll blow structure on momentum.
Wow.
If you looked at the momentum chart as opposed to the price chart, you'd see something totally different. In fact, you'd see something quite scary because you'd know, looking at the momentum chart, if you treated it as a price chart and drew your lines underneath lows and so forth, you'd say, oh boy, I don't want to break that line. Well, we're going to be on that line when we open next quarter. If we're just fiddle-farting around right where we are right now, okay? You go much lower, you're going to default those structures. When you go back to 29 and you do the same study, or 87, and I happened to catch that. I didn't catch it in a big way. I was a futures broker at the time, and I personally caught, and my clients did, with some small put positions, but we caught the 87 crash. And I saw then the same type of pending structure to break once we got into the new quarter. And sure enough, that's what happened. You had there was a range in the S&P where in the summer, mid 1987, where they kept selling and selling and selling. You burst through in August, and everybody said, oh boy, breakout, It's sort of like NASDAQ had a high back in July. NASDAQ 100 finally burst through a month ago or so, shot up there. But I said, oh boy, breakout, new leg starting. And at the end of that quarter, which then would have been September, third quarter, 87, you wobbled back off just enough in the month of September. So when you opened October and the numbers had shifted, you blew the structure. And you blew it in the first week or so of October 87. And by the second, you'd crashed. Now, I'm not going to argue that when we break these structures this time, and I think we are, that it has to crash. In fact, I can make an argument that no, probably it's not going to be of the 35% dimension in 2 weeks, which is what happened in 29 and 87. Boom, 2 weeks. Boom. Instead, it's more likely to be a sharp layered decline. I could be wrong. Maybe you do crash, but I'm arguing that when it shifts down, I suspect you're going to find some support at levels higher than what we'd call a crash level. Crash level being 30+% drop in a matter of a couple of weeks. But still, you've started a major breakage, trend breakage, and downturn. And I think you'll have seen at that point, once you break these quarterly structures, you can then circle the market and say, that was it. And that was the top. And going forward, down in massive layers for the next couple of years.
Gold's historic rally in 2024 is far from over as the new year approaches. However, many analysts are cautioning investors to temper their bullish enthusiasm, especially during the first half of 2025. While the yellow metal has experienced a remarkable surge this year, many experts predict its next significant rally may be delayed, with a target price of $3,000 per ounce for next year. However, this rally is not expected to materialize until the latter half of 2025, as markets focus on broader economic indicators and geopolitical developments. As gold prices consolidate around $2,650 an ounce, this target would still represent a solid 13% gain compared to the near 30% rally observed in 2024. Gold markets are currently in a wait-and-see mode as investors try to assess the economic landscape, particularly about stubborn inflation, a persistent issue. Investors are also grappling with geopolitical risks, with significant uncertainties surrounding global leadership and policy shifts, particularly in the wake of political changes in the U.S. Although the precious metal has been consolidating since its peak in late October, it has managed to hold steady, a sign of resilience despite significant headwinds. Notably, gold has managed to maintain crucial support levels around $2,600 an ounce, even after the Federal Reserve's final monetary policy meeting of 2024, in which it signaled fewer interest rate cuts for next year. While earlier projections suggested up to 4 rate cuts in 2025, the Fed now expects only 2, signaling a more cautious approach to its monetary policy. Please share your thoughts on Oliver's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.